Hello, everyone. Jeff here from Fundamentally Smart, and today I wanted to bring you a stock review of a stock that I am personally invested in, and that's going to be DR Horton. They are a home builder based out of Texas, so let's go ahead and dive right in and take a quick look. I want to get through this video a little bit quicker than most of the other videos. So I'm just going to focus on a couple key points and we'll go from there. So as I mentioned, they are a home builder based out of Texas. There's one of the largest home builders by market cap within the United States. Their market cap's currently sitting right around that 27 billion mark. So let's talk about some of the metrics that stood out to me. Currently, they're trading at about a 6 times multiple, which is in a really attractive entry point. They're sitting around the 52-week low range. So this could be a really good buying opportunity here for a very attractive price. Let's take a look here at some of the financials and other metrics. So one metric that I always like to mention beyond price to earnings ratio is going to be that quick or current ratio. We could take a look at that on Yahoo Finance for the statistics tab. Current ratio is sitting at 5.55. Very healthy. There's no short-term liquidity issues or anything that's going to arise from that aspect. Uh, so that's a very solid measurement there at about 5.5. Following that, let's go ahead and take a look at the previous earnings reports and how they did versus expectations. We can take a look and see that they beat 4 out of 4 over the last 4 quarters, which is very good. We're looking at almost 10% beats here in some of these quarters, which is very solid. It could lead to spikes around that earnings season, and that could be a nice little bump if you're looking for a short-term trade. If you're looking for a long-term trade, know that the company is consistently exceeding expectations on the earnings side. Following that, I wanted to take a look at the revenue and earnings growth. We see pretty consistent growth here with a big jump in 2021. Everyone was looking for a home. Not a big surprise there. And I think that's really going to continue. We do have a housing shortage, and I don't see any receding in that area. Now, one thing to note here for this one is going to be the rising interest rates could put a crimp on the business, as well as other economic influences can really have some big pressure when it comes to home builders. However, I think if you look at what the multiples were back in 2019, when the interest rates were trading at, the interest rates were 1.5%, 1 to 2% in that range, I think you could see some still very solid room to grow here. So another metrics that I wanted to look at is the net profitability here. We could look at that on the income statement, and this is going to give us an idea of the company's return on their sales. How efficiently are they marketing their product? So let's take a look at that. We could find that by taking net income and dividing that by your revenue. We could look at the quarterly function, and when we take the net income, which we could find down here, or we can find it right here. This is from continuing and discontinuing operations. It's just another way of looking at it. It's also what's available right here. You can see it's the same number in this case, so that's good. So we take our net income, which is 1,141,600, and we're going to divide that by our total revenue, 7,053,400, and we get a measure of just over 16%. It's a very healthy net measurement. Ideally, we'd love to see it north of 20%, but we're very close here. We are on an uptrend compared to the trailing 12 months. So that is very solid, a very good measurement for this company. Um, some of the other competitors here, we have Lennar, or Pulte, and they are trading at right around the same price to earnings metrics. So that's good. There's no concern. We're not a market outlier in that regard. So for this particular stock here, I could easily see a price target of at least 85% with a earnings per share of right around 13.70 coming in on their annual report in September. That's very conservative estimates, and that represents a 11.5% premium at this point in time. So we're going to do something different. I'm going to initiate a buy rating on this stock this time. We'll stick to the regular model: strong buy, um, hold, sell, and strong sell. So at this point, I am going to initiate a buy rating with an expected price target of $85, and that's based off the expected earnings per share of no less than 13.70. And I could fully expect them beating that given their previous track record. Thank you for watching. Don't forget to like, comment, and subscribe, and have a wonderful rest of your day.